Hey everybody, Nick here, and today I will be going over a discounted cash flow tutorial. So first, as you can see, I have an empty Excel sheet here, and I'm going to be filling it out, going through the DCF process step by step. Here, as you can see, I have the income statement and the cash flow items for Amazon, and here you have the completed version of the Excel sheet. So at the end, it's going to look something like this. So the objective for today is to help you understand the theory and mechanics of a discounted cash flow analysis. So first, I'm going to give you a definition of a DCF. Then I'm going to show you the 5 steps to complete a DCF. And then I'm actually going to implement those 5 steps. So what is a DCF? So first, here's the interview answer. It's pretty convoluted, but I'm going to go through this step by step. So that by the end, you should have a pretty firm grasp of a DCF. So a DCF is a valuation methodology that measures the intrinsic value of a company based on the sum of the present value of its future cash flows. The first step is to project a free cash flow for 5 to 10 years by making assumptions on the company's revenue growth and EBIT margins. Next, you calculate the terminal value by either using the exit multiple or perpetuity growth method. You then discount back your projected free cash flow and terminal value using your WACC to the present value and sum them together to get your enterprise value. Now the simple answer is that a DCF measures the value of an asset based on the amount of cash it can produce. And the purpose of a DCF model is to estimate the value of an investment based on its expected future cash flows. So the 5 steps that were previously mentioned in the definition, but they're just like easier to understand here, is first you project the future free cash flow, then you calculate the weighted average cost of capital, or WACC, then you calculate the terminal value, then you discount it back to the present value, and then you calculate the implied share price. So on to step 1. So as you can see here, this is the equation. So we get the EBIT, and we multiply it by 1 minus the tax rate. Then we add depreciation and amortization. Then we subtract capital expenditures, subtract change in net working capital, and then we get our free cash flow. So I'm going to start doing that now. So we're going to start the first step in the DCF model. As you can see here, I have the income statement and the cash flow items of Amazon. And below here, I have the DCF model with nothing in it. So I'm going to fill this one out. So first, I'm going to link the revenue to the income statement. I'm going to do Command C and then Shift and right arrow to drag the values all the way up to 2021. And then for the percent growth, I'm going to get the current year's value divided by the previous year minus 1. Then for the percent growth in our projection, I'm going to get the estimate from the income statement, which will be in our assumption. And then for the revenue, I'm going to get the previous year and multiply it by 1 plus our percent growth. Moving on to EBIT, I'm going to link the EBIT from the income statement. And then for the percent margin, I'm going to do EBIT divided by our revenue. Then for our percent margin in our projection, I'm going to link to the estimates of in our income statement, which will be an assumption. And then to estimate the EBIT, I'm going to do revenue multiplied by the percent margin. Then for taxes, I'm going to link the taxes from the income statement. And for the percentage of EBIT, I'm going to divide the taxes by the EBIT. link the percentage of EBIT from the income statement. And then to estimate taxes, I'm going to link the EBIT and multiply it by the percentage of EBIT. All right, now we're at EBIAT, which is earnings before income and taxes. Or excuse me, earnings before interest and taxes. And so this is just EBIT minus taxes. Then for D&A, I'm going to link it to the D&A in our cash flow items. So now for percentage of sales, I'm going to get the D&A and divide it by the revenue. I'm going to link the CapEx from our cash flow items. And for the percentage of sales, I'm going to get the CapEx and divide it by the revenue. Now for the percentage of sales in net working capital, I'm going to use the average of the past 3 years. I'm going to use the average function here. And now for the change in net working capital, I'm going to multiply the percentage of sales by revenue. Now finally, we're going to get to our unleveraged free cash flow, which is earnings before interest and taxes, plus D&A minus CapEx minus changes in net working capital. Now on to step 2. Now we're going to calculate the weighted average of the cost of capital, or the WACC, and the WACC starts with a general principle, which is that $1 today is worth more than $1 tomorrow. So to illustrate it, let's exaggerate it a lot, right? So let's say $1 million today is worth more than $1 million 100 years from now. And this seems pretty intuitive when you know about like inflation, as well as just the use of money, right? Money is more useful today than it will be in the future. So what is the WACC? The WACC is the rate of return required by debt and equity investors for your company to fund the growth of its future free cash flows. Now this discount rate is used to determine the present value of your free cash flows. So when it comes to these free cash flows, the cash flows of the future are not as valuable as the cash flows in the present. In order to calculate how much you should discount these free cash flows back to the present value is when the WACC comes in. Now this is our formula down here. So first, was the percentage of equity times the cost of equity plus the percentage of debt times the cost of debt times 1 minus the tax rate. Now this first part is known as the risk-free rate, which is the rate of return that you would get back. So for example, I think the safest thing would be probably a 10-year U.S. Treasury bond, because the U.S. Treasury is not going to have any issues, which is at about like, and the beta is how volatile your stock is compared to the market, and then the expected rate of return is how much you can expect to earn in the overall market, which is usually about 8 to 10%. So as you can see here, our free cash flows in 2022, and again, this is from the perspective that it's the end of 2021, start of 2022. So 2022 is the future, 2021 is the past. And as you can see, the free cash flows in 2022 was like $2,000, right? But then it goes up a significant amount. Now the thing is that the value of this, of 2023, of the 14,000 under 2023, is not the same as the 2,000 in 2022, because it's projected to be the future, so it needs to be discounted at a certain point. Now let's calculate the WACC. So this is another tab in our Excel sheet, and we're going to start with getting the debt, which is in our previous Excel sheet. Then we're going to calculate. Then I'm going to get the equity value, which I looked up. It's like 1.25 trillion for Amazon, so I'm going to put that. I know. Also, this is I know this is 1.25 million, but this is in billions. Then debt plus equity is obviously debt plus equity. Then the percentage of debt is debt divided by debt plus equity. And the percentage of equity is, again, equity divided by debt plus equity. And so the cost of equity is the risk-free rate plus the beta times the market risk premium. So let's do that. And finally, the WACC is, the formula is on top of the Excel sheet. So it is the percentage of equity times the cost of equity plus the percentage of debt times the cost of debt times 1 minus the tax rate. And here we go. This is our number for the WACC. Now on to step 3, calculate the terminal value. So the terminal value is the value of a company's future free cash flow from its last projected year until the end of time. Now this might sound a bit daunting, but luckily we're standing on the shoulders of giants and we have 2 formulas to help us. Now you can use either one, you can even average both of them, but first we're going to I'm going to use the perpetuity growth method, which is last year's free cash flow multiplied by 1 plus the terminal growth rate divided by WACC minus the terminal growth rate. The terminal growth rate is the rate at which the economy that you're measuring for grows generally. So for example, the US economy, the US is like GDP increases by 3% per year generally. So that's the terminal growth rate. Now we're going to implement this equation on Excel. So first I'm going to link our value that we solved for the WACC, and it's going to be up here for our valuation assumptions, the WACC and the terminal growth rate, and we're going to implement the terminal value equation, which will be the last year of the future free cash flow multiplied by 1 plus the terminal growth rate, and all this divided by the WACC minus the terminal growth rate. And here we have our terminal value. However, now we need to discount it back to the present, which will be step 4. All right, now we're going to discount back to the present value. We do this by getting the free cash flow for year X, and we divide it by 1 plus the WACC to the power of year X. Now this might sound a bit confusing, but once you get into the Excel, it's a bit more understandable. So first, we're going to get a free cash flow, and then we're going to divide it by 1 plus the WACC, which is found up here. Then we're going to close the parentheses and power it to the year that we're calculating for. And here we go. Then we're going to drag down this equation to the other years. And now for the present value of the terminal value, we're going to do the same equation, but instead of doing it with the free cash flow, we're going to do it with the terminal value. All right, now let's get to step 5, which is to calculate the implied share price. Now, here we're going to sum the present value of the future free cash flow, and we're going to add the present value of the terminal value to get our enterprise value. Then we're going to subtract debt and add cash to get our equity value. And then we're going to divide the equity value by the number of shares, which will lead us to our implied share price. So let's do this in the Excel right now. So first, for the enterprise value, I'm going to use the sum function. And I'm going to get our present value of future free cash flow, and add a comma, and also get the present value of terminal value. So this is our enterprise value. Then I'm going to calculate the equity value by getting the enterprise value and adding cash and subtracting debt. So then this is our equity value, and then I'm going to divide the equity value by the number of shares to get our share price. And here we get 140.02 cents. Now, our implied share price is $140. Now, this data is from July of 2022, so it's not, made to assess Amazon's stock price today, right? Nor is this investing advice, right? This is just like proof of concept, showing you what it's like to be in the trenches of making a DSF financial model. Hope you enjoyed the video. Let me know how I can change this at all, and what you thought about this little production that I made. Yeah, have a nice day.